And just to let you know, like we might avoid that government shutdown here, possibly, or go into the weekend and have it resolved by early next week. We did see the House now pass a stopgap funding bill, so we'll be watching. And sometimes government shutdowns rattle markets. Other times it doesn't. Like they're going to try to get a stopgap bill done in time here, so we'll be watching that. Predicted the rally that we had on Friday. The Dow was up 1.18%, up almost 500 points, 498. The S&P was up 1.09%, up 63.77, back above 5,900. Nasdaq was up just over 1%. The Russell was up just under 1%, and again the VIX was down 23.79%. About the VIX in just a moment, but the VIX did predict today's rally. We got it. It is predicting a down day on Monday. Whether that'll be correct or not, we'll see. Now, with the PCE inflation data, initially we saw the market gap down here on the 5-minute chart, and we completed a divergence here, rebounded back up to the 200, got above it, and then came back and tested the 50 as the 50 was getting above the 200 period, and then we dropped back and closed below both by the end of the session, pulled back off of the highs. The VIX predicted today's rally. I talked about that on Thursday. The VIX has been predicting bounce or bottom as of that huge move that we had with the Fed on Wednesday. It created extreme fear in the market. And I talked about how we had a 75 or 74% move, I should say, surge on the VIX in one day. On the Fed day, got back above the 50. We're still above it, but we're moving down towards it. VIX was up over 20%. I was predicting that we would get a bounce or bottom within the next two sessions, 95% chance. And we did. We got a rally on Friday. So now the question is it a bounce or is it a bottom? Well, we got the extreme over here. We're up 150% in one day with that topping tail. We didn't close there, but we saw it surge 150% in one day. That did mark the August bottom after the July sell-off there in early August. See something similar here? Maybe. Easily. The markets can be manipulated over the holidays up or down. So we'll be watching. If we stay above the 50, then that's problematic. But if we end up dropping back below it, the 50 period's a green line right there, then we could still see the market, bid up over the holidays on the short trading weeks and the lighter volume. The institutions are leaving for an extended vacation, and retail investors very well could bid it back up. We'll be watching. But it can be, if we stay above the 50 here, it can be manipulated. If volatility starts shooting higher, then you throw out these percentage moves. Now, this one did play out. We had one Thursday and today, both predicting that we're going to have down day on the S&P on Monday. We'll be watching, again, these huge percentage moves up and down on the VIX. Interesting. So we'll see if the next signal plays out, we get a down day on Monday or not. Then I'll be watching. Do we drop back below the 50? And if we do, we can get a rally. If we hold above it, then again, the manipulation might be to the downside. We'll be watching to see how it unfolds. Do we sell off to the downside and get a bigger rally in January up? Or do we try to get a rebound right now? Is the top end on the S&P? Guesses it's not, but again, I've been showing you both possibilities. As I told you, I was looking for a December or January top, and it very well may be that we get it here in December. I think you got a good shot that the Dow and the Russell have peaked. The jury is still out for the Nasdaq, but again, we'll be watching a big rebound here on the S&P 500 today. The VIX predicted the rally that we got today. The VIX was correct yet again. It's not perfect. More often than not, it is correct. Now, we got the PCE inflation data today. You may recall that we saw an uptick on the PPI, the wholesale inflation, a couple of weeks ago. So this was being watched. Again, I told you if it came in cooler than expected, we could get a rally. If it came in hotter, we could get a bigger sell-off. Well, we ended up getting a rally. The VIX was predicting a rally for Friday, 95% chance that it happened. The VIX was correct. We had the PCE data come in on a month-over-month basis, lower than expected at 0.1%. Same thing with the core PCE data, both of them beating there on the month-over-month. And then we had the headline year over year come in at 2.4, was expected to come in at 2.5, and the 2.4 was just slightly up from the 2.3, but it came in better than expected. That's why we got a rally today in the market. But this earlier in the week that if we could see cooler PCE data, that we might see a rebound in the market to either backtest the broken trend line on the S&P, or mark a short-term bottom, because we did reach extreme fear on the Fed sell-off. The core year over year came in at 2.8, better than the 2.9 that was estimated, and the 2.8 is right in line with what we previously got. So we got a rally on the PCE data, the Fed's favorite gauge of inflation. Next week we'll have the Christmas Day holiday, short trading week, an abbreviated session as well. And then the following week we'll have New Year's, and again another abbreviated session. The market can easily be manipulated up or down. And again, I told you we could see the PCE data start a rally in order to give us a rally on lighter volume. We'll be watching. Now, there is of a government shutdown, and again, sometimes there's negative, the market reacts negatively to that. Whether they avoid that or not, I don't know. Last I looked, we were still headed for one, but again, they could dodge that over the weekend, and if they do, then it doesn't become an issue anymore. But sometimes we see sell-offs surrounding that or uncertainty. Whether that's going to be the case here, who knows? But again, we'll be watching. Maybe the market shrugs it off. Maybe we get the volatility to the downside. More and more signals turn bearish. We'll be watching. Now, initially the market gapped lower on the inflation data, and we got a big rally. This is what it looked like right at the beginning of the market. We were at extreme fear with the fear greed index. The previous day, we had 2022 as well. We're at extreme fear. Previously, we were at a neutral area, starting to drift down ahead of the Fed meeting. We begin to move off of the extreme fear and fear levels. Again, we could see a rally over the holidays on extremely light volume as the institutions have their money managers go on early vacations, and again, well, the cat's away, the mice will play, and we could have the retail investors try to bid prices back up. That's what it was here at extreme fear, but by the close, we get the rally up 1%, just over 1% there, and again, we moved out of extreme fear to a reading of 28. The extreme reading could try to mark a bottom, or again, we still might carve out one. But so far, this divergence right here with the fear-greed index has given us a sell-off so far. We might attempt to recover now. It's also possible, again, we could be easily manipulated up or down on very, very light volume. But if we get further selling, again, be getting a rebound in January after a bigger sell-off. But if we get it now, then again, the next 2 weeks or shortly thereafter, if we get the rally now, we could see the S&P still try to rally up to the upper channel line in the weekly time frame. We'll see a peak, just after the holidays, or just surrounding the holidays. But again, it could go on into January. The question is, do we get a rebound over the holidays? If we do, then you got a pretty good shot. That rally is done within the holidays or shortly thereafter, that we could see more selling in January. But if we get a sell-off holidays, then they'll try to rebound, run it back up. But we've had a big sell-off on the Dow and the Russell. We might try, as I've been saying, to see a rebound by the retail investors and see them bid it back up. We did reach extreme fear this week here, this past week here with the Fed, the Fed sell-off. So here's the fear greed index in blue. Again, it reached extremes down here below 25, and it's moving up now above 25 at 28. You see S&P up here in red. They did diverge with the October peak to our recent highs here. We did see a divergence there we get another rally, it still may be better defined. We still may go up here and get another reference point of a divergence. You'll see the S&P attempt to reach a new all-time high in the upper channel line in the weekly time frame that I've talked so much about. Now, if we remain down at fear and extreme fear, we can get a bigger sell-off. But again, I am expecting a rally. Either we get it here and now, light volume over the holidays going into January, and reach that level in a couple of weeks, just after the holidays or in the holidays, trading. If we end up getting a bigger sell-off, we see more signals turn bearish, we start seeing a manipulation to the downside. If we see manipulation to the downside, then we can get a bigger rally in January. So we'll see if we can get the rally right here and right now. Then we got to see momentum signals all begin to turn back to bullish. So if we move off of the extreme fear and fear levels and flip momentum back to bullish, we can attempt a recovery. And the market could be manipulated up or down over the holidays. So we'll be watching. Does momentum stay bearish or does it flip back to bullish? Now, I'll talk more about the weekly charts in my next update, so check back for that. On Sunday, I'll also talk about the NASDAQ at that time. We try to work in the Dow and the Russell as well. So we'll be talking about these weekly charts, and here's the NASDAQ. Can the Dow recover from this nearly 7% drop that we've had now? I'll be addressing some of these things in my next update. Same with the Russell. I'll be sharing some important things about the weekly charts and the sequence counts, so stay tuned. Check back for that because, listen, something really important to show you with the sequence counts. We'll be talking about the NASDAQ, its attempted rebound off the 50-period moving average. Please support the channel with the link directly below that allows me to be able to provide you this information. If you like the chart, you like the indicators, please take a moment to support the channel. I don't have any sponsors. I turn those offers down because I just want a direct relationship with you. I want to sell you a bunch of stuff you don't need. But if you could take a moment to help out, I would really, really appreciate it. I thank you for your consideration for that. If you follow the link below, it'll take you to a secured site and you can donate any amount you want. Thank you very much. The stocks above their 20-day moving average has moved down to an extreme, to single digits here. And again, very, very similar to the April low over here after this sell-off right here. So again, we've had multiple point divergences that have given us these sell-offs over and over, and then this larger divergence develop. That's now given us this sell-off. Does it evolve into something bigger? Or again, do we attempt a recovery? Here, we've reached an extreme on stocks above their 20-day moving average. So it is possible that we attempt a recovery, better volume, if we can see momentum turn back to bullish. We got to see that happen. Next update, I'll be talking about the bearish momentum on the S&P 500, and is that going to remain the same and end up taking us towards the 200 period and back to horizontal support? Will that take us back to horizontal support of the 200 period moving average, or do we see the stochastic begin to try to find a bottom and turn back up, or do it immediately? We'll be talking about the awesome oscillator a little bit in my next update and on those weekly charts as well. As what I'm watching is, do we just get a back test and end up going lower? Is that what we're doing here? We lost the 50-period moving average on the S&P. We broke the trend line. Do we, just back test right here? So 10 and 20 are getting a bearish cross. Or do we end up trying to get back above the 10 and 20, back above the trend line, and try to form a divergence right here with momentum and other indicators? Continue to decline. We have our 100-period moving average below, and the possibility of a channel line if we have a channel that is carving out, that we find support around the 100-period moving average, and then we rebound back up. And again, this trend line parallel to this upper boundary of the rising wedge right here. We didn't reach it, but we did turn off the July trend line, the red trend line right here. We turned off at that level. I'll be watching. And then we went sideways, formed the triangle. The triangle had a downward resolution. So now I'm watching. Do we try to rebound back up, back test, and get a bigger sell-off? Or, which again, could have been completed here today, or a little bit bigger? Or do we end up getting something bigger recovery on lighter volume and try to end up forming a divergence on some indicators? S&P daily right here. And by the way, right below the 100 and this parallel trend line to the upper boundary here, you have horizontal support. And this is where we found support at the July peak right here. This is where we found support right here. When we broke out above it, we back tested, we formed a triangle, we broke out, and then we formed another triangle. We had a downward resolution, but I told you I thought we were going to bounce off that 50 in horizontal support. That was correct, and that's given us this trend line, which my trend line slightly moved on me here. Now here's the S&P daily chart with the RSI, and again, it could be that we end up seeing a multiple point divergence develop and still end up trying to go to new highs, or sell off further and then try it in January, or we may try it immediately here in early January if we can rebound back up. So we'll be watching to see how it unfolds. But again, still possible we reach that target level in the weekly time frame. So again, we got that little tiny divergence here marking this peak right here at the trend line from July. I'll be watching to see if we go back up and test that trend line again, or try to get above to this trend line, which again was the upper boundary of our rising wedge. So again, do we just back test? Do we to get above this horizontal support level? Now it's resistance, so we'll be watching these levels. You know, one thing about the 50 period, the green line right here, we're below it right now, where we drop below it, and then we close just slightly above it. But last time, ahead of the election, we bounced off of it, and then over here we dropped below it, just below it, ahead of the Fed meeting, and I told you we were going to get that Fed pivot rally. We did, and again, we were just below the 50, and we got back above it and resumed the advance. So again, just pay attention to the 50 period moving average. Here we dipped below it, got back above it. Here we bounced off of it. Do we see something like that here, or do we have to come down further? We do have this horizontal support level as well right here. We slightly violated it, but again, it was the gap support with the presidential election results right there, and we bounced off of it there at the 20 period. Here we slightly violated it, but then we closed back above it. So again, we'll be watching these levels. So we do have the gap right below here at 50, what is it, 57.83 or something like that, 57.87, whatever it is. But that high 5,700 area, and then right below that again is this horizontal support level here from our July peak. Another thing to note is, again, the MACD did form a divergence between the November high and our recent high here in early December, and then we went sideways, forming the triangle. You could see it here. We had the downward resolution of the triangle. MACD's come up to the center line here. If it goes negative, we'll get a bigger drop. If we firm up around here or go negative briefly and then turn back up, then we can attempt to get another reference point of a divergence. We had a little divergence here that did give us this sell-off right here. Last time we were down here, this is where we bounced just ahead of the election, right there at the 50 period moving average, and then the time before that was just below the 50 period. So again, here we are again. So does the MACD stay consistently in positive territory? And if it does, that really marks the uptrend. We'd have to go in negative territory below zero and stay there in order to have the downtrend. So just some things to be paying attention to as we go into the lighter volume during the holiday trading here. Now here's a price action on the 60-minute chart. Again, with the PCE inflation data, we ended up gapping lower, but we got this little hollow red candlestick, candle of indecision, in the form of a spinning top on the 60-minute chart, and then a big rally up and rebounding back up there and moving higher by just over 1%, and then we saw momentum turn back up. And I warned you again, Try to bounce off this area. I talked about that in Thursday's video. Again, this is the gap support area here. We just slightly violated it. And again, this is where we previously bounced off the 200 period. This is where we previously bounced off the 20 period in the daily time frame. So here we're trying to bounce. And again, you got a little divergence on the 5-minute chart and the 15-minute chart to do that. But here, bouncing in the 60-minute time frame, again, we'll be watching to see if we break back down below this level, do we go back to fill this gap here? And it is, I think it was 57.87 or something like that. And again, this gap is the presidential election results gap right here. So just something worth paying attention to. Again, you still have the possibility of a little miniature head and shoulders as well. So we'll keep watching that. But again, very possible the S&P has not peaked yet. I think you got a pretty good shot. The Dow has, and the Russell, and again, as I say, the jury is still out on the NASDAQ. Okay, I stand corrected, 57.83. There it is, right there, the gap fill. If we move to fill that gap, and if we get a more, another reference point of a divergence, because we do have one right here on the RSI. Okay, and again, this is a divergence that developed very similar to the one that we had over here at the November low, just before we got the election results rally there. All right, here we got a higher low, and I told you to be watching for that. Again, we reached extremes. I told you to watch to see, do we form a divergence? Do we form a higher low? We got the divergence. We went a little bit lower with the PCE. If we can bottom out, if that marks a bottom, this is suggesting we either got to get a bounce or a bottom. Well, we're getting a rally, so we're either getting one or the other. If that's it, then again, we can try to go higher, and then we'll see if we can recover. And if we could try to make new all-time highs on the S&P 500. Remember, the S&P did not reach its upper boundary of the channel in the weekly time frame. The Dow and the Russell did. Now, if we get another reference point of a divergence, we can come back down here and still come down and try to fill this gap and then try to rebound back up. We'll be watching that. There's horizontal support directly below that. So remember, we can see manipulation up or down. We've got light trading volume. We'll see which way the wind blows here. But right now, you've got a divergence that's trying to give us a rebound here with our push lower for the session with the PCE inflation data. The MACD did not get it. The MACD did not get a divergence yet. It doesn't have to. Over here, it did. Right here. Over here, it did not. Okay, at this low right here. If we just get a low, we can go. Get back into positive territory if we're going to recover. But it still may be we end up seeing a divergence develop here. If we get a triple bullish divergence, I should say, on the RSI in the 60-minute time frame. Are you picking up what I'm throwing down? Watching the divergence, does that give us a bottom here or not? Or is it just a counter trend bounce and we're going to end up going lower? I'm still bearish. Keep that in mind. The 50 is dropping down to the 200, which is now dropping. So again, we'll be watching, do we get a death cross? And if we do we end up getting a bigger drop? Or can we see momentum flip back to bullish and get a recovery on lighter volume over the holidays? Other recession indicators that are flashing. This is the Conference Board Leading Economic Index. It's been declining since 2021. You get these sharp declines right before recession shows up. We had it with the self-imposed shutdown with the pandemic. Here you can see what it looks like a little bit better with the last two recessions that associated with the bear markets. And again, here is 2007, the recession there, and the recession that showed up in 2001. Again, after the 2000 peak, after the 2007 top. We had it in the 90s, we had it in the 80s, we had it in the 70s, so on and so forth. Every time we've started to see a sharp decline, recession did follow. This has been a longer period, months, but it is still going to happen. If we look at this based on percentage terms, as well as how many months from the peak, when it peaks, to the start of the recession, you get a pretty good idea that the indicator's warning of a recession. Now here, we have seen 33 months from the peak in 2021 So it's gone on longer. I think there are reasons for that. But from the peak to when the recession started, it was 20 months for the financial crisis. Some periods longer, 16 months, 14 months. Some periods shorter, 7, 8, 10 months, 9 months. Now, we're being told we've avoided a recession by Powell over at the press conference here last Wednesday. Look at this based on percentage drops. Every time you've dropped here by 5%, every time since the 1960s. This is looking at the other chart that we just looked at based on percentage terms. Every time we've dropped more than 5%, a recession has followed. Now, again, every single time for decades when we've dropped more than 5% from the high, on percentage terms with the Conference Board Leading Economic Indicator, the LEI, every single time we've had a recession. So this time, no, this time is different. No, this time is not different. Oh, we had the soft landing in the mid-90s. We had the soft landing. Well, we never saw this drop by 5%. Again, it's a fairy tale, this soft landing stuff. We had lowered rates in the 90s, larger rate hiking cycle, and they never lowered it to new lows. I can go on about other things, about poppycock, about a soft landing. You see for yourself, did we go 5% in the 90s? No, we didn't do it. We didn't drop down there. Did before the recession hit in 2001, we saw the Conference Board Leading Economic Index drop in 2000. We saw the stock market peak in 2000. Just telling you, those people told us, oh no, we're going to have this soft landing. That's a bunch of baloney. That's a bunch of Kool-Aid for the herd. Okay, I'm telling you, you look at this chart, there are other indicators. Feds look at focusing on inflation, which is a lagging indicator. Oh, we got to focus on inflation. Inflation was higher in 2007 and 8 than it is right now, right when the recession started in December of 2007. Eventually, it went higher, and ultimately, the deflationary bust dealt with the inflation. Every time we've seen this decline of greater than 5% from the high, you've had a recession. You had it in 2020. You had it with the bursting of the financial crisis. You had it with the bursting of the tech bubble over here. You had it back in the 90s and on into the 80s and 70s, all the way back into the 60s. It's not been wrong. It's not going to be wrong now. We've seen this decline. Oh, it ticked back up. It ticked back up after dropping 17.6% from the previous peak. Oh, it ticked back up. Oh, the recession's been avoided. We're going to get a soft landing out of the Fed. It's a bunch of Kool-Aid for the herd. Again, this is telling you we're going to have a recession. Every single time we've had a recession, but no, this time is different. No, this time is not different. A recession is going to be bad. I wanted to share that with you. There are other recessionary indicators that are giving warning signs. I'm trying to share some with you. Conventional wisdom is that we're, as Powell said, the press conference. Conventional wisdom is have the soft landing, and the Fed has avoided a recession. And again, it's arrogance. The Fed is now believing their own false narrative that is simply not true. They didn't see the recession in 2007. They didn't see the recession in 2001. So why would they see the recession now? I think a lot of it is just arrogance. They didn't see the inflation. You know, today I wrote something about the Fed. I write a lot of things about the Fed, but I talking about how the Fed is as blind as Mr. Magoo. Magoo was that cartoon character from yesteryear. Was always bumbling and stumbling around, and he had a problem with his eyes. He had a problem seeing what was right in front of him. That's what the Fed is doing right now, and it would get him into trouble, and he would have all kinds of problems happen, and it was a cartoon that showed all the problems he would get into because he couldn't see what was right in front of him. What the Fed is, and again, I think that's a great analogy. I got that from Jeffrey Gunlack and I hope I'm saying his last name right there. If I didn't, I apologize to him. But he was talking about that. I made that reference a few months ago when I was listening to an interview that he was doing with CNBC, and I thought it was a great analogy of what's going on with the Fed. Real fast, I've talked about how the Fed was blind to the recession in 2007. Again, they were extremely hawkish about the inflation, just like they are now, making the same exact mistakes back that they did back in 2007 that they're doing right now. But I also talked about writing my thoughts down today on the Fed. I also talked about how the Fed was so dovish in 2021 when they should have been hawkish, because the CPI in April of 2021, it rose to 4.2%. So we started seeing it tick up. By the end of the year, it was at 7%, and then it ended up shooting up to 9%. By the time the Fed finally figured out, hey, we better start raising rates, they kept telling us it was transitory. They were wrong about not being concerned with inflation. They were wrong to be dovish. They should have been hawkish. They should have been worried about the inflation, not dismiss it. Kept rates too low for too long, and that's why they had to do the jumbo rate hikes, because they were clueless. Now they're doing the complete opposite. Now they're laser focused on inflation when they should be focused on the recession, doing the exact same thing they did back in 2007 and 2001. Talking about their soft landing nonsense, which is not going to happen. Now, everybody believes, we're not going to get cuts out of the Fed. We're going to get just a couple cuts out of the Fed maybe in 2025. And a lot of people are saying we're not going to get any cuts out of the Fed. We're going to have to raise rates back up, some others are saying. Social media. Look, I'm telling you, inflation's going to go higher, just like it did in 2007 and 2008. It went higher. But we're still going to get the rate cuts out of the Fed. Nobody thinks that's the way it's going to play out. Nobody. Telling you, that's the way it played out in 2007 and 2008. I was there. I was there when the Fed was panicked in 2001, and they were blindsided by the recession then too. Wrong about the inflation being transitory in 2021. Should have been hawkish. They were dovish. Now they're hawkish on inflation when they should be dovish. They made the same mistake in 2007. They should have been dovish right before that recession. We saw the deterioration in the labor market back then. And I've been through all that. We saw the warning signs, but yet the Fed was completely oblivious to what was going on. That's what the Fed does. Their models are completely wrong, causing them to make monetary policy mistake over and over and over again. Remember the housing bubble? They kept telling us there is no housing bubble. Bernanke said that over and over and over again. That is blind to these things. Be blind to the recession that's about to start, and it's likely going to start in Q1 or Q2 of 2025. Before it starts, the market will peak and begin to price it in. Nobody thinks we're going to get these rate cuts now, and I'm telling you, we're going to get jumbo rate cuts in 2025 because the recession indicators are predicting we're going to have a recession. And I, for one, believe the recession indicators. The Fed dismisses them